If you've ever heard of investment firm Blackstone, it's probably because of its habit of buying up family homes and making it harder for renters to become homeowners. But Blackstone doesn't just own homes. It also has a huge portfolio of commercial real estate around the world. And now, with the real estate market in a downturn, Blackstone has a huge problem. The value of the real estate it owns is plummeting. And in the post-pandemic era of working from home, its office towers are sitting empty. With cash drying up, Blackstone has started defaulting on its debts, and the worst may be yet to come. If Blackstone goes under, it won't just be big-time Wall Street players that will get hurt. That's because numerous retirement pension plans are invested in Blackstone's funds. Millions of Americans are relying on Blackstone for their retirement, even though they might not even know it. But let's back up for a moment. What exactly is Blackstone, and where did it come from? Simply put, it's a New York-based investment management company. Its core business is creating investment funds that it operates. It collects money from investors and then pools that money to buy large assets such as corporations, office buildings, and large collections of apartments and houses. Then it collects income from those assets and pays it out to investors, all while keeping a juicy cut for itself. Blackstone launched back in the 1980s and became a big player in one of the sleaziest practices Wall Street invented at the time, the leveraged buyout, or LBO. Essentially, Blackstone would take over corporations with money it didn't have. They would borrow an enormous amount of cash and then use that cash to buy a business, usually for a price well above that company's current value on the stock market. For this reason, it was popular with shareholders and Wall Street insiders who made huge amounts of cash from LBOs. But then the buyers in the LBO would saddle the business they bought with the huge debt they ran up buying it. The result was that many businesses were saddled with debts they couldn't pay, and eventually, some of those companies went under. Share prices collapsed, employees were thrown out of work, and entire corporations disappeared. There were famous examples back in the day of major businesses going belly up because of LBOs, such as Federated Department Stores, today known as Macy's, and Revco drugstores. If you've never heard of Revco, the leveraged buyout is why. At the same time, BlackRock was busy innovating a new product called the mortgage-backed security, or MBS. They bought large numbers of mortgages from local lenders, bundled them together, and sold them on to investors as securities. Blackstone partnered with another investment firm, one with a confusingly similar name, BlackRock. BlackRock's founders had basically invented the mortgage-backed security back in the 1970s when they were working at Lehman Brothers. The Blackstone-BlackRock partnership put the MBS business into overdrive, and soon they were selling countless billions worth of mortgages on the market. MBS were a pretty good deal for mortgage lenders and for investors. Mortgage lenders got fresh cash with which to lend more mortgages, and the investors who bought the pooled mortgages had a steady stream of income. And it worked until it didn't. During the 2008 financial crisis, it turned out that a lot of MBS had mortgages in them that had been issued to subprime borrowers, people who couldn't afford those mortgages if they lost their job, or if any number of other things went wrong for them. Billions worth of MBS turned out to be worthless. The wipeout of the MBS market was a major cause of the financial crisis. But that didn't stop Blackstone. As house prices crashed, it went on a buying spree. Unlike with previous real estate purchases, this time Blackstone focused on buying single-family homes, sometimes renting them out to the very people who had lost their homes to the foreclosures during the crisis. And Blackstone had a huge advantage over regular homebuyers. Thanks to their connections inside Wall Street banks, and because they were borrowing enormous amounts of money, they got lower interest rates than what lenders offered other homebuyers. This meant that Blackstone could outbid regular homebuyers for the same homes and rent them out at a larger profit than an ordinary landlord could. Today, Blackstone owns a giant portfolio of office buildings, apartments, and houses. By some measures, it's the largest landlord in the world. It owns not just housing and offices, but student dorms, vacation resorts, and warehouses. In 2022, its real estate portfolio was estimated to be worth around $280 billion, or about a third of the $900 billion in assets that it has under management. Its flagship investment product is a real estate investment trust, or REIT, which has $125 billion in assets and $55 billion of debt. Remember that 55 billion number, because debt is becoming a huge problem for Blackstone. Over the past year, with inflation running hot, the Federal Reserve and other central banks have raised interest rates at the fastest pace in a generation. That's causing real estate prices to fall, and Blackstone's fortunes are falling with it. Blackstone may have bought real estate on the cheap back during the financial crisis, but in recent years, as real estate prices soared during the pandemic, they were buying high. Now, they might be forced to sell low. As recently as a year ago, Blackstone was planning a massive expansion of its real estate holdings. Now those plans are falling apart. For now, Blackstone's problem is primarily in commercial real estate. It turns out that the new era of working from home is bad for the office business. Before the COVID-19 pandemic started, the office occupancy rate in the U.S. was 95%. At the peak of the crisis, it fell to just 10%. Commercial real estate investors didn't panic because they expected that people would return to the office once the pandemic was over. But that didn't happen, at least not entirely. As of late 2022, the office occupancy rate was just 47%. New rental leases for office space have dropped to a fraction of what they were before the pandemic, and revenue from new leases is down 17.5%. Monthly rents are down, and so is the amount of space businesses want to rent out. According to a study from the National Bureau of Economic Research released in October of 2022, this has erased $453 billion from the value of U.S. office real estate. Blackstone is already feeling the pressure. The first sign of that came in December when its flagship real estate income trust, known as BREIT, or BRIGHT, hit its redemption limit. This means so many people were pulling their money out of the fund that Blackstone put a freeze on it, essentially telling investors they can't take their money out. It was the investment fund equivalent of a bank run. But unlike with depositors in a bank, Blackstone can freeze investors' money in place because it's written into every investor's contract that the company can reject requests for withdrawals if those withdrawals hit a certain level. The limit for Blackstone's funds is 5% of the fund's value in a single quarter. The fund's $55 billion in debt is becoming a big problem. When the Fed started raising interest rates in early 2022, the requests for redemptions in Blackstone's fund began growing almost instantly. Many investors in the fund clearly understood that this real estate fund was only a good bet so long as interest rates were low. A few weeks after the freeze, news broke that Blackstone was putting its future plans for real estate investing on hold. And over the course of 2022, Blackstone's share price fell by more than 40%. In 2023, things have only been getting worse. In early March, Blackstone defaulted on a $562 million debt linked to a portfolio of office buildings it owns in Finland. It had bought a Finnish property company, Sponda Oy, in 2018, along with its portfolio of 45 properties, mostly office buildings, for €1.8 billion. These buildings are mostly old, C-class offices that don't rent out for much, and their vacancy rate is a whopping 45%. They're nearly half empty. And here's the thing, they weren't in great shape before the pandemic. When Blackstone bought them, they had a 35% vacancy rate. While interest rates were low and borrowing was easy, Blackstone was willing to buy just about any piece of property. Now this buying spree is catching up to it. And they're not the only ones. Other major real estate investment funds are also in trouble. Brookfield Asset Management another big player in the commercial real estate market, has defaulted on nearly $800 million in debt on 2 office towers it owns in Los Angeles. Its share price has fallen so far, it's at risk of being delisted from markets. Chetrit Group has defaulted on nearly $500 million in debt on 43 apartment buildings in New York. It recently sold an office building in Midtown Manhattan to one of its lenders for a $156 million loss. And in what may be the largest real estate default yet in this crisis, PIMCO, the famed Pacific Investment Management Company, defaulted on a $1.7 billion debt tied to office buildings in New York, San Francisco, Boston, and New Jersey. And here's the thing. This problem is going to get a lot worse before it gets any better. According to NBER, more than 60% of office leases haven't come up for renewal since the pandemic began. When they do, landlords like Blackstone are going to discover that their tenants don't need nearly as much space as they used to, and aren't willing to pay nearly as much for the space they rent. The carnage in the office market is only just beginning. In 2023 and 2024, around $1.1 trillion of commercial real estate debt will come due. Unless interest rates come down very far, very fast, there will be many more defaults. And that's going to be a problem, not just for investors in BlackRock and other real estate giants, but for banks as well, since about half of that money is owed to them. And it will be a problem for ordinary people as well, because many retirement pension funds are heavily invested in these real estate investment funds. Pension funds representing 31 million retirees are invested in Blackstone alone. That includes CalPERS, the California State Employees Pension Fund, as well as the Pension Fund for California Teachers and the Pension Fund for New York City employees. So when this problem kicks into high gear, it will have huge implications for the entire economy. If investment funds like Blackstone and Brookfield get into serious trouble, as in insolvency or bankruptcy, there's a chance that they will get bailed out. After all, these days, the government seems intent on bailing out any business whose failure could cause panic. But that doesn't mean the value of these real estate investments will come roaring back. Blackstone and the others bought real estate at high prices and with a lot of debt. Now the value of these properties is falling, and the debt is becoming more expensive. So you might want to get your money out of Blackstone, if you can. The free ride is over, and it's time to pay the piper. If you like this video, hit the like button and make sure to subscribe to this channel for more insights on the world of finance and economics.